the method of charging penal charges will change this quarter is something that we are aware of. And the reason why I'm saying that the impact will flow through from this quarter is that the RBI circular says that for older accounts, it goes live from this quarter. The newer accounts, it went live from the prior quarter. So, because older accounts are the preponderant share of our total advances, that is why this quarter is where you will get an impact. Now, we believe that a reasonable share of that revenue, we will be able to get back a reasonable share by a series of measures that we are in the process of taking. We don't think there is going to be a very substantial impact. Let me turn this over to Vinod, who can, perhaps give you a little bit more color on current penal charges and where we see this penal charge going as we go forward. Thank you. Sorry, am I audible?
Very feeble and very muffled.
Some disturbance in the line.
Sir, there's a background disturbance from the Vinod sir's line.
Can you put him on mute, please, Vinod?
Okay. Yeah. So with regard to the penal charges, of course, there will be some pressure on the income side going forward because that is the intent of the true spirit of RBI circular. So, but however, what we are expecting is that going forward, we should be able to recover by the pricing, adjusting the pricing also, we should be able to adjust that loss in the interest income. So we are not expecting much impact on the same in the coming quarters.
All right. And so when we are discussing about this pricing, so it seems that your disbursement rate and repayment rate has increased this quarter. So have you reduced duration of loans or anything there that needs to be reduced?
So the disbursement amounts that you see are largely driven by corporate disbursement. And these are short-term loans that corporates borrow from periods from 7 days onwards. And given the fact that corporate India has now reasonable liquidity, and given the fact that we were coming out of the busy season and etc., we had significantly larger churn. So the duration of our portfolio on the corporate side has always been short. The duration on the retail and the wholesale, retail and commercial is significantly longer. So the quantum of dispersal that you see is driven by corporate dispersals, and maybe we should try and give them breakup of corporate versus other dispersals as we go forward. We'll try and include those data points so that you get a better idea of what those dispersals stand for.
Sure. And so on yield on investments, if you can explain what led to the sharp increase in this?
Yield on investments has gone up.
Yes.
Not gone down.
It's one of the reason for increase.
The reason for increase is very simple. If you see that the total book, we have allowed it to shrink, which is where the lower yield instruments matured, it came in. We stayed in other asset categories and did not build the investment book. So we're waiting for the appropriate time for us to build the investment book. Wherever we get opportunity to invest at an appropriate rate, we did, and thereby managed to get the yield on investments to go up. So there's been very active management on the treasury part, as is very visible from the size of the investment book. So this has been actively managed to ensure that the total yield to us is reasonable.
Okay. And just last question, on these business loans, the slippage run rate seems to be around 150-160 crore on a balance sheet size of 15,000 crore. Is that a nominalized run rate, or how do you see that run rate?
So on the business loan front, NPA accretion for the quarter was about 172 crores, which, if you were to normalize, it's on a balance sheet size of, it used to be approximately 16,000 or so crores. This run rate does look a little higher than where we would like this to be. Largely, it is coming from the historic portfolio. And it's also a sign that the portfolio by itself is aging, in the sense that the new book here is actually is not growing as fast as we would like it. And consequently, since the denominator is not growing, the percentage numbers look a little wonky. This is an area of focus, and we are hoping that we can get growth back. We want to focus in areas where delinquencies and loss rates are low. So we've had discussions with the credit bureaus, etc. We've identified locations where portfolio performance happens to be good. And those are the areas we want to focus on so that we can grow this book and over time bring the loss levels to acceptable parameters. In addition, what we've done is we've started building scorecards so that the small end of the business loans can be automated as much as possible. And thereby, credit quality can be managed a little bit better, and we get more consistency on the credit quality side. So I trust that answers your question.
Sir, when you say this was a historical portfolio, meaning how long? Because I guess when Murli sir was there in 2020, he also started implementing all these scorecards. So it's been 4 years. So how to read into these numbers?
No, good question. Good question. It's 600 crores on a portfolio of about 15,000 crores. That's roughly a 4% slippage rate. It is, in our estimation, double of what we can afford, and for the portfolio then to stay profitable. The loss rates are continuing to come from historical books. These are not assets that have been onboarded from 2020 onwards. These are historical assets that were on our books, which are now not performing the way they are supposed to perform. An asset that is onboarded, it is hard for us to get out of that asset. It's a little easier to get out of assets on the corporate side because there are other takers. But on the consumer side, on the small business side, given the small ticket size that you very often have with these loans, it is a little harder to do because of the fact that monitoring of very small loans is done on a portfolio basis and not on an individual basis. And when you're looking at portfolio statistics, you sometimes miss out these individual cases that are going bad, and for you to exit loans, you have to do it before they become bad. So there are issues here. The good news is the newer vintages are performing better. The older vintages are not. We are hoping that this will, the flow through into NPA of the older vintages that are of poorer quality will, peter off at some point in time, and the losses will sponge. But there is some distance to go on that. So, it will take us a little bit of time before that happens.
All right, sir. Thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Rakesh Kumar from B&K Securities. Please go ahead.
Yeah, thanks a lot, sir, for the opportunity. Question is very similar, sir, here. So what I was looking at that for this quarter, the total slippage number is around 340 crore and 341 crore. And if I look at, March quarter, presentation, we had a total old book of 23,800 crore, out of which 45% is basically A plus rated. So basically 55% of the book where the slippage might be coming from, and also in this presentation, like corporate slippage is 0. So basically 341 crore is slipping from 55% of 23,800 crore. As you also said that new book, gross NPA number is somewhere close to 37 bits or something like you commented just now. So just wanted to understand, is it the right understanding if the slippage is coming from the old book? Run rate seems to be very high.
Okay, let me just restate what you just said. Our total NPA for the quarter slippage was 341 crores. None of it was from corporate. Corporate is 40% of our balance sheet, 42%. So for the purpose of this argument, we'll say 40, right? So 60% is the rest. 60% comprises roughly 50,000 crores. From that, our slippage is 341 crores. So 341 crores times 4 is about 1,400 crores on 15,000 crores. So that is running at a significantly higher run rate, as you point out. Now, total slippage on the new book, live to date, gross NPA is 223 crores. This is live to date. I don't have numbers for slippage this quarter on the new book. We will try and provide that to you as we go forward. But as you can see, the slippage is 341 crores is significantly higher than the live to date slippage on the new book. So the new book slippage has to be perforce a significantly smaller number. Do you have the deck for the last quarter? It will have the last quarter number. Yeah. So we just pull it out from the website and we'll be able to give you the difference. Huh? So okay, the slippage on the new book is 87 crores in this quarter out of 341. So the old book slippage was 254. 87 crores on 60,000 crores is still a reasonable number. I mean, you're less than 0.5% or near about 0.5% on an annualized basis. So, which I think is and this has a vintage now. It's not a new book that came yesterday. It has been there for 4 years now. That looks okay. Now, 250 crores of slippage on 22,000 crores is a little bit of a challenge because it is 5%. But as you know, this is a book that is winding down, and the bad loans that were to go bad have gone bad. The question is how many more will go bad. It's a question for which we have very limited answers. But what we will try to do is try and give you breakup of all of this so that it becomes a little clearer for you as to where the slippage is coming from.
Correct, sir. So the thing is that, I was doing a similar calculation, what you explained just now, that, if you analyze this 341 minus 87 crore for this quarter, or if we try to see what is the annualized slippage rate, and obviously this, because as you said that the 87 crore is from the new book, so that number I have reduced. So I am looking at 341 minus 87 into 4 divided by 23,800 crore, and of that only 55%, because 45% the corporate book is not giving any slippage to us. So then this number is mind-boggling actually. So I am thinking that then this 23,800 crore number, which was there on March, it will take couple of quarters to run down actually. And this kind of slippage rate will continue that way.
So apparently either I have misspoken or there is a understanding error. So 87 crores came from a portfolio of 60,000 crores. That is the new book, right? There the slippage rate is 0.5% or a little over 0.5% annualized, which is acceptable for a 4-year vintage book. So if I were to remove 87 crores from 341 crores, I get roughly 254 crores. 254 crores on 23,813 crores. That is about 1,000 crores, 1,200 crores, no, 1,000 crores So that will be roughly 4% and touch.
So actually, sir,
Yeah, go ahead.
sorry to intervene, sir. Actually, we could not take this denominator as 23,800 crore because the 45%, which is A plus, is not giving us any slippage. Corporate slippage is zero. So of the
So the corporate book, see the old book contains the corporate book of the past as well, and it contains the new corporate. Majority of the corporate book will feature as new corporate, is my estimation. The old book perhaps contains more of the MSME and retail and agriculture and gold and so on and so, or maybe not gold because gold is short duration. So it will be MSME, agri and retail and some mortgage loan against property and so on and so forth. I don't think the high quality corporate is part of the old book. Now that's a good question. We can peel the onion and show you what the numbers are. We don't have the data here right now, but in the next presentation that we make to you, we'll peel the onion and show you where the NPA is coming. Very clearly, the old book continues to bleed at a level which we don't like. We are doing our level best to do this. I must make one point very clear. Q1 of every year, we see seasonally high NPA slippage. Essentially because in the month of April, we have a change of approximately 30 or 40% of our branch managers. They change at that point in time. It takes some time to settle down, and some of our collections, especially for MSME, is branch manager driven. So if you were to look at the last 8 quarters or 12 quarters, you always find the first quarter has the highest slippage. This will normalize as we go forward. At least that is what we expect. So looking at this in isolation may not be appropriate, is the point that I want to make.
Correct, sir. Thanks a lot, sir. Many thanks for the effort and for the elaborate explanation. Thanks and all the best, sir.
Thank you very much.
Thank you. Ladies and gentlemen, this will be the last question for today, which is from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi, sir. Good evening, and thanks for the opportunity, sir. So just to reconfirm, I have one or two clarification and then one question. So what we said is that yield on advances have gone down, but yield on assets have improved because there is a higher delta on yield on investment. That is the right understanding, right?
Yeah. This is correct. That is, the yield on advances has gone down, and we have the yield on investments have gone up.
Right. Okay. And if you have given any update on the affordable housing and the, one or two new products that we had introduced recently or that we would like to introduce. Of course, we had thought on last quarter, we had said that we would want these products to be approximately 1,000 crore each. But is there any, update on that as to how that is shaping up?
With respect to affordable housing, our progress is relatively slow at this point in time, Jay. We've launched the product. Unfortunately, we don't have a dedicated loan origination system through which it can be fed. So everything is manual. And being manual, it takes time for us to turn loans around. So as of now, we do not have a significant, we've not made very significant progress, but we are hoping that a new system to address this can come in place by February of next year. So it's going to take some time because we have a bunch of other things that we are working on. With respect to home loans, standard home loans, we are making very good progress. So disbursal growth is in triple digits or close to triple digits. Housing loans, Q1 of this year was 96% more than Q1 of last year. Auto loans was 161% greater than disbursals were 161% greater than Q1 of last year. So those are growing nicely, albeit on a small base. Agri also we had significant success because there again we had a bunch of new products which were agri-based products which we think are of better credit quality. There again, we got 108% growth in disbursements when compared to the prior year. So we are making progress. Some of these new products are taking a little longer. We launched a product called GST Power in April, on the 30th of April this year, which is during this quarter. This we think is an industry leading product. We've got I think approximately 1,000 applications, if I'm not wrong, and that is doing well. Yeah. In addition to this, the supply chain business that we've been working on also grew 36% year on year. So there has been substantial progress in many of these products. The effect of all of this will take time because the balance sheet size is large and the starting position of many of these products is small. So, effect of compounding will only come over time, as you know.
Right. Okay. And sir, if on slippages, right, so I take your point that first quarter is seasonally weak, and the new book continues to do very well. But how should one look at the slippages? Is this, let us say, a new normal? Is it like 350, 300 or 350 levels? Is that, barring seasonal variation, how should one look at the full year slippages number?
Full year slippage, we think will be 1,200 crores or thereabouts. I mean, that is where we think we should be. I mean, from the current information that is available and visibility that we have, we say 1,200 crores. Which basically goes to show that 341 is a little bit of an outlier. So we think that we should be under the 1,200 crore number.
And this will include everything from restructuring also, right? I mean, there is no double funding.
Everything together.
Right. So in a way, this is a seasonal thing, more or less. It looks like a seasonal uptick. Okay, so that is good. And lastly on OPEX, sir. So, other banks' commentary suggests that they are increasing OPEX, right, across banks' cohort. But here, what we are trying to do is to cut or to contain OPEX on both staff and non-staff. So wanted to understand, sir, are we, sort of under-investing, or you think there are some easy avenues wherein you can cut costs and still not impact the usual business growth?
So, Jay, your business strategy is dependent upon where you are, your own current situation. So, had our situation been, that our cost to income ratio was 45% or 47%, our approach to business would have been different. And we would have said, okay, we're going to invest, we're going to put up new distribution channels, we're going to do a whole bunch of things so that we can grow business, which is from front-loading our expenses and revenues will come later. In our case, we are running well past 60% as cost to income. And consequently, our strategy also has to be moderated. So what we are doing is we are trying to invest in places where we can get disproportionate returns and manage expenses very, very tightly. So our year-on-year expense growth is 15%. It is only quarter-on-quarter sequential where we are flat. So there has been a very significant growth in expense over the last few years. So what we are trying to do is juice out those expenses. We are not saying we are not going to invest. Our strategy on the distribution side is still evolving. We will have to change our distribution. We cannot remain dependent only on the branch. And perhaps the approach that we had saying that, we will build non-traditional distribution using digital channels may not be enough. So we may need to have other distribution channels which will increase costs for us. But we'll have to do it judiciously and with time. So we are not cutting those off, but our focus remains on managing costs very tightly given our particular situation right now.
Right. And sir, this 15% OPEX growth, is it like good enough estimate for full year as well?
Hey, Baba, I said 15 years growth. It is 15% growth on a year-on-year basis is what we have disclosed for this quarter. Last quarter expense and this quarter expense are roughly the same. There is not much movement. right? We will have some amount of expense growth from here, as we go into future quarters. That is driven by inflation on all the products that we consume. So I think there would be in our case, we are trying to maintain that, to monitor that and control it tightly. As you can see, our headcount is decreasing, which is the largest chunk of our costs. So doing all of this, we think that our total expense-based growth for the year should not be more than 10%. At least that is the aim. And we want to grow revenues more than that so that we widen PPOP. That's the whole plan that we have.
Right. Understood. So yeah, so that is all from my side, sir. Thanks a lot. And over to the operator.
Thank you. I would now like to hand the conference over to Mr. P.R. Seshadri for closing remarks.
So let me take this opportunity to thank you all for being here with us today. We did have a reasonably good quarter. I think we are making progress on many of the strategic elements that we set out to do. We also welcomed a new addition to the board, Mr. Dolphy Jose, as an executive director. I think he brings a wealth of talent to our company, and we are very excited to work with him as we make this transformation journey for ourselves. So allow me to thank you all for being here and thank ICICI Securities for hosting this conversation. Thank you very much.
Thank you, sir. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and now you may disconnect your lines.